So let's break down the question. XYZ Limited is a company that manufactured electronic components, and the company it has recently completed a major expansion project which has affected its capital structure, right? And here is the financial data we are working with. The first is long term debt, $5 lakh. The next is current liability, $2 lakh. Shareholder equity, $4 lakh. Net income, $50,000. And total asset, $12 lakh. Now the question asks us to calculate the debt equity ratio, that is called DER. And options have been given. There are 4 options. Okay, so now which one is it? So first let's define what we are calculating. We are calculating the debt equity ratio, that is called DER. So this ratio shows the relationship between the company debt and net equity. 2 things are there. Now, the first thing is company debt, and the second thing is equity. So in simpler terms, it tells us how much debt the company has for every dollar of equity. Now to calculate this ratio, we've only considered long-term debt. So we are not including current liability in our calculation, just the long-term debt. Right to understand, this is very important. We are including only long-term debt, right? So we will modify our formula like this. DER is equal to long-term debt. Earlier I wrote debt, but now I am writing long-term debt divided by shareholders equity. So now in this case, can you tell me what is the long term debt? Let me move to the previous slide, and you can see it here. Long term debt is how much? $5 lakh. So our numerator will be how much? Our numerator will be $5 lakh. And what about the shareholder equity? It is nothing but $4 lakh. So if we divide both of them, what you will get? You will get debt equity ratio which is equal to 1.25. If you divide both of them, you will get 1.25. So the correct answer is option number A, that is 1.25. So now the question is, what does this 1.25 really means? Well, it tells us that XYZ Limited has 1.25 of long term debt for every dollar of equity. यानी $1 इक्विटी के लिए, $1 इक्विटी के लिए, यानी ₹1 इक्विटी के लिए कंपनी एक्स के पास जो XYZ के पास टोटल $1.25 जो है डेप्ट है. तो you can see it clearly that ratio is greater than 1. That means DER is greater than 1. So a ratio D greater than 1 indicates that company is using more debt than equity. Obviously ये ratio क्या indicate कर रहा है? ये company जो है debt ज़्यादा use कर रही है as compared to equity to finance its operation. ऐसे केस में क्या होगा कि एक्सपेंशन प्रोजेक्ट लाइकली इंक्रीज द कंपनी रिलायंस ऑन डेप्ट. तो ऑब्वियसली बात है, इन सच केस द एक्सपेंशन project is likely increase the company reliance on debt, which is reflected in the debt equity ratio. तो दोस्तों ये डेप्ट इक्विटी रेशियो को समझना बहुत जरूरी है, क्योंकि ये इन्वेस्टर को और स्टेक होल्डर को एक इंसाइट प्रोवाइड करता है कि कितना रिस्की कंपनी का फाइनेंशियल स्ट्रक्चर हो सकता है. यदि ये रेशियो ज़्यादा है, मतलब कि रिस्क ज़्यादा है, खासकर यदि कंपनी स्ट्रगल कर रही है अपने डेप्ट ऑब्लिगेशन को मीट करने के लिए. सो रिमेंबर, हायर रेशियो कुड मीन्स मोर रिस्क, स्पेशली इफ द कंपनी स्ट्रगल टू मीट द डेप्ट ऑब्लिगेशन. So this was about the question number 1. The correct answer is 1.25. Now let's move on to the question number 2. So in this question we are going to interpret the debt equity ratio we calculated the earlier for one XYZ Limited. Okay, so first question is what does the debt equity ratio is of 1.25 indicates about XYZ Limited financial structure? Earlier we have about this answer 1.25. Now it asks to interpretation. Options are: the company is heavily reliant on equity financing, the company is using more debt related to equity, the company has an optimal capital structure, the company has no debt. Equity ratio है यानी DER is 1.25. What does it mean? It clearly means that for every dollar of for every one unit of equity, so it means for every 1 unit of equity the company has 1.25 unit of debt. That is means सिंपल सा मतलब है कि 1 यूनिट इक्विटी के लिए कंपनी के पास 1.25 यूनिट है डेप्ट का. इन सिंपलर टर्म्स, XYZ Limited is using more debt than equity to finance its operation. This is the key indicator that company is relying heavily on borrowed fund. इसका मतलब यही नहीं हुआ कि कंपनी जो है हैवली रिलाई कर रही है किस पे, बोरोड फंड पे रिलाई कर रही है ताकि अपने बिजनेस एक्टिविटी को फिल करें। चलिए ऑप्शन वाइज चलते हैं। पहला ऑप्शन कह रहा है कि कंपनी इज हेवली रिलायंट ऑन इक्विटी फाइनेंसिंग, तो ये सही तब होता जब रेशियो 1 से कम होता, ठीक है, तब ये सही होता। लेकिन इस केस में रेशियो 1.25 है, तो ये ऑप्शन गलत है। ऑप्शन बी कह रहा है कि द कंपनी इज यूजिंग मोर डेप्ट रिलेटिव टू इट्स इक्विटी, ये बिल्कुल सही है, 1.25 रेशियो यही इंडिकेट कर रहा है। ऑप्शन सी कर रहा है कि कंपनी हैज़ एन ऑप्टिमल कैपिटल स्ट्रक्चर। देखिए रेशियो यदि 1 के आसपास हो ना, तब फिर वाइल अ रेशियो अराउंड 1 कुड बी कंसिडर्ड बैलेंस, वेदर इट इज ऑप्टिमल डिपेंड्स ऑन इंडस्ट्री, कंपनी गोल एंड अदर फैक्टर। ऑप्टिमल है या नहीं ये कंपनी गोल पे डिपेंड करता है, दूसरे फैक्टर्स पे डिपेंड करता है, लेकिन इस कंटेक्स्ट में हम सिंपली इंटरप्रेट कर सकते हैं कि ये रेशियो बेस्ट फिट नहीं है। ऑप्शन डी कर रहा है कंपनी हैज नो डेब्ट, ये तो ऑब्वियसली गलत है। द कंपनी हैज नो डेब्ट ऑब्वियसली विद अ रेशियो ऑफ 1.25, द कंपनी डज हैव अ डेब्ट एंड दिस ऑप्शन इज इनकरेक्ट। So what we can see that this ratio 1.25 suggests that the company is somewhat leveraged. So we can say that this ratio 1.25 suggests that company is somewhat leveraged, meaning it has taken on significant debt relative to its equity. A stakeholder who need to monitor this to ensure that company does not overextend itself and end up in financial trouble, right? So you can see understanding the DER help us in assessing a company financial structure and potential risk. A ratio above 1 indicates a high reliant on debt, which could either be a strategic move or a potential risk depending on the situation. So hopefully this concept is clear now. चलिए आगे बढ़ते हैं हम लोग, क्वेश्चन नंबर 3 पे आते हैं। देखिए ये एक सीरीज था, एक केस स्टडी था डेब्ट इक्विटी रेशियो पे, इस प्रकार के सवाल आए थे। क्वेश्चन ये आपसे पूछा जा रहा है कि when a company reduces its debt specifically how that affect the debt equity ratio. Now suppose the company reduces the debt, so how DER will be affected? So here is the scenario, if XYZ Limited अपने लॉन्ग टर्म डेप्ट को $1,00,000 से कम करना चाहते हैं और शेयर होल्डर के इक्विटी को कांस्टेंट रखना चाहते हैं, तो नया DER क्या होगा? तो सबसे पहले आपको याद रखिए, रिमाइंड कीजिए अपने आप को, फर्स्ट ऑफ ऑल लेट अस रिमाइंड आवर सेल्फ ऑफ द ओरिजिनल DER विच वाज 1.25, वी हैव जस्ट कैलकुलेटेड। सो ओरिजिनली जो हमारा लॉन्ग टर्म डेप्ट था, ठीक है, लॉन्ग टर्म डेप्ट जो था ओरिजिनल, यहाँ पे मैं ओरिजिनल लिखता हूँ। सो ओरिजिनल जो लॉन्ग टर्म डेप्ट था दैट वाज हाउ मच, दैट वाज $5,00,000, राइट। एंड नाउ ओरिजिनल शेयर होल्डर इक्विटी, ओरिजिनल इक्विटी शेयर होल्डर का इक्विटी जो ओरिजिनल था हमारे पास वो था 4 लाख, राइट। तो ये तो ओरिजिनल वाली बात हो गई। अब क्या हुआ कि इसने डेप्ट को 1 लाख से कम कर लिया, तो जो फाइनल डेप्ट है इट हैज़ रिड्यूस्ड बाय 1 लाख विच हैज़ बिकम $4,00,000, राइट। इट हैज़ बिकम $4,00,000 because it has been decreased by 1 lakh. You can see reduces long term debt by 1 lakh. So the shareholder equity remain constant. It is almost 4 lakh only, right? So now can you tell me what is the new DER? So new DER will be how much? This long term debt divided by shareholder equity, which is nothing but 1, right? So the correct answer is 1. Option number A is correct. That is what is the new DER, which is nothing but 1. So this new DER, what does it tells us? Well, now that the debt and equity are equal, XYZ has a balanced capital structure where every 1 unit of equity is matched with 1 unit of debt. This might be more comfortable position for the company as it reduces its financial risk by lowering the amount of debt. Reducing debt can be a smart move for a company if it want to decrease its financial risk, and it definitely affect key financial ratio like the DER. In the XYZ case, bringing the ratio down to 1 suggests a more balanced and potentially safer financial structure. Hopefully this concept is clear now. Now let's come to the next question. Next question is why might a company with a high debt equity ratio be considered a disadvantage? So very good question कि किसी कंपनी का हाई DER है तो वो डिसएडवांटेज क्यों है? Let's go through the option. First option से because it means the company is using more equity financing. This is actually wrong. Actually high DER suggests the opposite. It means company is using more debt, not equity. So option A is incorrect. Option B says because it indicates high dependency on debt which could affect its ability to service the debt in the event of low profitability. So this is the right answer. When we talk about high DER, if we talk about high debt equity ratio, it indicates that the company rely heavily on borrowed fund. What does it indicate? That company rely heavily on borrowed fund. company is relying heavily on borrowed fund. If the company profit fall, it might struggle to make interest payment and repay the principal, putting it in a risky financial position, right? So high DER, what does it mean? It indicates company rely heavily on borrowed fund, and in such case, if profit fall, it might struggle to make interest payment and repay the principal. So this is how this high DER is not considered a advantage; it is considered a disadvantage, right? So this is the correct answer, which could have. And suppose the company profit fall, low profit is there, then how company could manage its principal and interest payment, right? It could not manage. So option C says because it suggests the company is not investing enough in the capital intensive project. So while a high ratio could limit a company ability to invest in project, this is not the direct reason a high debt equity ratio is disadvantage. So this is not the best answer. And option D says because it means the company is highly profitable. So high DER does not directly indicate profitability. In fact, it could be the sign of financial strain if the company is unable to generate enough profit to service its debt. So option number B is the correct one. Right, a high DER shows the company is heavily reliant on debt to finance its operation. While debt can be cheaper source of funding than equity, especially when interest rates are low, it also comes with obligation like regular interest payment and eventually repaying the principal. If the company profit falls, it might struggle to meet these obligations, leading to financial distress or even bankruptcy in several situations. That's why a high DER can be risky, and why company with this kind of ratio might be at disadvantage compared to those with a low ratio. So in summary, while debt can be an effective way to fuel growth, too much of it can put a company at risk, especially if the profit is not stable. So always keep an eye on company debt equity ratio while analyzing its financial strength. So that's the point which we are covered in this particular slide. Let's move on to the next question. The next question says that why the debt equity ratio might not be the best tool for comparing company in different industry. Very good question. So there are 4 options are given. Option A says because different industry have different level of capital intensity. So what do you think? This is the correct answer. Industries like manufacturing. Let's talk about some industry like manufacturing and utilities, which are capital intensive industry. So these industry manufacturing are capital intensive. So they tend to have high DER. They have high debt equity ratio. They tends to have high DER due to large investment in long term asset. Why they have high DER? Because they have large investment in the long term asset. On the other hand, industry like technology industry, or suppose consulting industry, so these industry which are less capital intensive, they might have a lower DER, right? They might have lower DER. Why? Because this difference makes direct comparison between companies in different industry less meaningful, right? So option A is the correct one. Option B says because the ratio does not account for market condition. So while it is true that debt equity ratio does not reflect the market condition, this is not the reason it is not applicable for cross industry comparison. Option C says because companies in different industry uses different accounting practices. So different accounting practices can affect financial ratio, but this is not the primary reason the debt equity ratio might not be comparable across industry, right? Option C says because companies in different industry uses different accounting practices. Different accounting practices can affect financial ratio, but this is not the primary reason. Option D says because it only considers short-term liabilities. Actually, the debt equity ratio focus on long-term debt, not short-term liability. So this option is also incorrect. What is the correct option? The correct option is option number A. So the debt equity ratio reflect how much a debt company is using to finance its operation as compared to equity. However, the amount of debt a company need can vary significantly depending on industry. For example, some industry that requires heavy investment in physical asset like manufacturing, they have typically high DER. This is because they often finance the large investment with debt. On the other hand, service-based industry or technology company might have lower DER. Come on to the next case study that we have, which is related to the PEP, right? Break even point. So let's see the question. The question is like this: ABC Limited manufactures and sell custom-made widget, and they want to determine their break-even point in units. So here are the financial details given, like selling price per unit is given $10, variable cost per unit is given $6, fixed cost is given $2,000, and the question is asking you to calculate how many. That is a break-even point you have to calculate. And what is break-even point? You know what is this break-even point? So this break-even point means what? How many unit does ABC Limited need to sell to break even? Friends, if you are preparing for CCP examination, that is IIBF certification course CCP, and if you are looking for any study material, a perfect study material which caters to your need, either in the form of PDF, videos, quizzes, previous year questions, then you can contact me on this particular number. We have an course available for the CCP examination, and this will help you to achieve a good marks in the examination at with lower effort. With low effort, you can get the maximum output. So if you are interested in this, kindly WhatsApp me on the number shown on the screen, and in the description section also I have provided the link of the courses. Now let's come back to this particular question. So we have to calculate the break-even point in units. So you know what is what is break-even point. So see, first of all we will go through the formula, that is fixed cost divided by selling price per unit minus variable cost per unit, right? So this is how we calculate the break even point. So this is by using the formula, right? But I am telling you a best way to solve such type of problem. No, not using the formula, because sometimes if you wrongly wrongly remember the formula, everything will be wrong. So let me give you an insight into this thing. See, try to understand what I am saying, that suppose you have to draw this type of pie chart. Okay, so this is a circle. Okay, and this complete circle has two parts, right? So you know there is a selling price per unit, and there is a variable cost per unit, and there is a fixed cost per unit, right? So the total cost will comprise of two things. What is the meaning of this fixed cost? Fixed costs are the costs that do not change no matter how many units you produce. So this will not change, this will remain constant. What is the selling price? This is the amount that ABC Limited charges for each widget. And what is the variable cost? It is the cost to make each widget. See, let me make you understand using this particular circle. So this entire circle represents the selling price, and you know the basic formula, that selling price is equal to cost price plus profit, or it may be loss minus loss, right? This is the thing. Okay, so what you do, you divide this particular circle into two parts. Okay, so this part represents the variable cost. Okay, and if you subtract this selling price minus variable cost, this will give you contribution margin per unit. This will give you contribution margin per unit, or you may represent it by small c. So this portion which I am showing by suppose I take this color. Okay, so this portion is what our called contribution margin. This is called contribution margin. Now if we talk about this contribution margin, let me move on to the next slide. Yeah, so let's come to this slide. Let me erase this thing. Hopefully you have understood what is contribution margin. And see, if we talk about this contribution margin is make up of two things. See, let me draw it again. I think it is not drawn perfectly. Yeah, try to understand this concept. This is very important concept. Once you understand this concept, you can solve any type of break even point question easily. See, this is our contribution margin. This contribution margin is comprises of two things. The first thing, it comprises of fixed cost, and the second thing, it comprises of the profit, right? So two things are there in the contribution margin, that is fixed cost and profit. So what I do, I have just exaggerated this particular portion in the form here, and suppose I draw this is the center, this is the point, and I said this particular point, I said this particular region. Okay, and I also said this particular region. So this portion, suppose it represent our fixed cost, and this portion suppose it represent our profit, right? So you can see this contribution margin, this entire portion contribution margin, it comprises of fixed cost and profit, right? So what is the meaning of break even point? Break even point means a point at which profit is zero. a point at which profit is 0. Now you can see, if the profit is 0, then this shaded region will become 0, or we can say it quite easily that this entire fixed cost will become equal to our contribution margin. Right? Am I clear? What I'm saying, that what is the meaning of break even point? Break even point means this profit is 0, and when profit is 0, this fixed cost will be equal to contribution margin. Right? So this is how we will calculate it. So now let's go back to this particular question, and let's dive into how to calculate using this particular thing which we have discussed just now. So see, this entire circle is how much? $10. Okay, and this portion which is variable cost is $6. So this portion will be $4. This is $4. Right? Now this $4 is our contribution margin per unit. Okay, and we know at break even point contribution margin is equal to our fixed cost, and this contribution margin can be written like contribution margin per unit into number of unit is equal to fixed cost. Now you know what is contribution margin per unit, which is nothing but $4. Number of unit we want to know, suppose n is the number of unit, and fixed cost we also know, fixed cost is how much? $2000. So you can simply calculate n is equal to 2000 divided by 4, which is nothing but 500 units. So this 500 units is our what? This is a 500 units is our break even point. That means, what does it mean? That means ABC Limited need to sell 500 widgets to cover all its fixed and variable cost. There will be no profit, but it will be able to cover its fixed and variable cost. At this point, company is not making any profit, but it is not losing money also. It is breaking even. Any sales beyond 500 unit will start generating profit for the company. So understanding break even point is crucial for any business. It helps to set sales target and make informed decision about pricing and cost. Right? Now let's come to the next part of this particular question. Now suppose the next question is, what is the break even point in terms of sales revenue for ABC Limited? Try to understand. Earlier it was asking break even point in units, and we got the answer 500 units, but now the question is in terms of sales revenue. Very good question. So in terms of sales revenue, how can you calculate? It's quite simple. See, you know how many units you require to break even, and you simply multiply the number of units with selling price per unit. Right? You will get break even point in terms of sales. How many units are there? 500 units are there. And what is the selling price per unit? Tell me, what is the selling price per unit? It is nothing but $10. Right? It is nothing but $10. So the break even point in terms of sales revenue is how much? $5,000. So what does this $5,000 represent? So it is the total amount of revenue that ABC Limited needs to generate to cover both its fixed and variable cost. In other words, if ABC Limited brings in $5,000 from selling its widget, it won't make a profit, but it won't incur a loss either. It will just break even. Right? So earlier we calculated break even point in terms of unit, and now we calculated the break even point in terms of sales revenue. Now let's come to the third part of this particular question. The third part is, what is the margin? What does the margin of safety measure? See, first of all, question is asking what does margin of safety measure, and the next part is what is the margin of safety? That's the point. See, margin of safety, what are the options? The difference between actual sales and break even sale. So this is the correct answer. Margin of safety tells you how much your current sale exceeds the break even point. Right? How much this is your current sale. Suppose this is your current sale level, and this is your break even point level. Right? So essentially it measures how much sale can drop before the business start incurring loss. Option B say the total fixed cost covered by the sale. This is wrong. This sound close, but it's actually not what the margin of safety is. Option C says the profit earned beyond the break even point, while this sound close, but it's actually not margin of safety measure. Option D say variable cost and fixed cost difference. This is not margin of safety. Right? So the correct answer is option number A. Let's talk about why margin of safety is important. Imagine your business is doing well and you are selling more than the break even amount. The margin of safety tells you by how much. This is crucial because it shows how much sale can drop before you start losing money. For instance, let me give you an example to make it more clear. For instance, suppose your margin of safety is high. So in that case, you have a larger cushion. You have a larger cushion. right? Which means you can withstand a decline in sale without worrying too much about dipping into loss. On the other hand, a low margin of safety indicates that even a small drop in sale could put you in business at risk. So understanding the margin of safety help you gauge the financial health of your business. It is a great way to assess risk and make informed decision. So next time you are looking at your sales figure, don't forget to calculate this important matrix, that is margin of safety, right? Hopefully the why option A is correct is clear now. Now, why it is important for a company to calculate this break even point? Very good question. So options are to determine the maximum profit that can be achieved. No, this is wrong, because break even point does not tells you about your profit. It is actually covering cost. Option B says to understand the level of sales needed to cover all costs and avoid losses. See, now this is correct answer. The break even point is all about finding out the minimum sales volume required. The break even point is finding the minimum sales volume required to ensure that all the cost, both the fixed and variable, are covered. It is a point where your business is not making a profit, but it is also not incurring any loss, right? Option C says to calculate the amount of debt that can be handled. See, while debt is important consideration for any business, it does not directly relate to the break even point. Option D say to decide the selling price of the product. So setting the selling price involves many factors, but the break even point is specifically help in understanding the sales volume. So why it is knowing your break even point so important? It is simply the foundation of financial planning. If you don't know the minimum amount of sale you need to avoid any losing money, you are flying blind. Understanding your break even point help you set realistic sales target, manage your expense. For example, you know you need to sell 500 units just to break even. You can strategize around that target, whether it is adjusting your marketing effort, cutting cost, or even reevaluating your pricing. So calculating break even point is not just a good practice, it is must for any business that want to stay afloat and grow. It gives you a clear picture of where you stand and what you need to do to succeed. Now let's see the last part of this particular question. If ABC Limited want to achieve a profit of $1,000, how many units must it sell? Very good question. So how many units it must sell to achieve a profit of $1,000? So how to calculate this? So earlier I have told you to do this particular diagram. So see, what is the selling price per unit? Selling price per unit is 10 rupees. What is the variable cost? It was 6 rupees. So this area is how much? 4 unit, which is called contribution margin per unit, right? And in this case, if you exaggerate this particular area, it has been given that profit is $1,000. So this area is profit and this area is fixed cost, right? And fixed cost is given how much? $2,000. I think you remember it. $2,000, right? So you know contribution margin is 4, contribution margin per unit is 4. So we can say contribution margin per unit multiplied by number of unit, this would be equal to how much? 2000 plus 1000, which is equal to 3000, right? And what is the contribution margin per unit? It is nothing but 4. So 4 multiplied by n is equal to 3000, right? So n is equal to how much? 3000 divided by 4, which is equal to 750 units. Is it clear now how to calculate it? No need to remember any formula, just remember this particular circle. Again I am repeating this question. See what you have to do. The selling price is given 10, the variable cost is given 6, so your contribution margin per unit, which is noted by small c, is equal to 4. And this contribution margin comprises of the two part. The first part is fixed cost and the second part is what? Your profit, right? So this contribution margin capital C is equal to the fixed cost plus profit. What is fixed cost? $2,000. What is profit? $1,000, which is nothing but 3000. Your contribution margin is 3000, and contribution margin is represented by contribution margin per unit multiplied by number of unit, which is small c. It is a small c, right? So c into n barabar 3000. So n is equal to how much? 3000 divided by small c. And what is a small c? The small c is 4. So it is nothing but 750. Is it clear now? So this way you have to solve such type of problem. You no need to remember any formula.
Bankruptcy code. Which of the following is not a key component or authority involved in the resolution process? So you have been asked which is not a key component or authority involved in the resolution process. Let's go through the option. The first option say resolution professional. So let me give you a brief idea. So it is a central to IBC process. If we talk about this, in short we call it RP. So RP is the central to the IBC process. They manage the insolvency process. Not only manage, they coordinate between creditors and oversee the preparation of the resolution plan. So think of them as a project manager. You can think of them like a project manager, ensuring that all stakeholders are on the same page to resolve financial issue. Right, so they ensure that all the stakeholders are on the same page to resolve financial issue. That is called resolution professional. Second option we say information utility. Yes, correct. So the information utilities, you can think of them like a database, that store and authenticate financial information of debtor. So that stores and authenticate financial information of debtor that help in faster decision making. Right, so imagine a digital library that gives verified financial data instantly. You can imagine them like a digital library which give verified financial data instantly. So this help creditor and professional act swiftly. The third option say executive authority. So see, executive authority, if we talk about, so you know what NCLT is National Company Law Tribunal, and you know about this DRT, Debt Recovery Tribunal. So this NCLT and DRT act as the adjudicating authority. They approve or reject insolvency application and ensure fair proceeding. They are like judges in the courtroom, deciding whether a case qualify for the resolution process or not. And the option D says interim resolution professional. So this is the incorrect option. There is no concept of interim resolution project in the IBC. Instead, the correct term is interim resolution professional. I think this no project, right? So this the correct answer is IRP, interim resolution. We can call it interim resolution professional, who temporarily manage the insolvency process until the resolution professional is appointed. So the correct answer is option number D. So what is the key takeaway from this particular question? First of all, we have seen the RP, which is the main person managing the insolvency resolution process. We have seen the information utility, a trusted source of financial data for quick decision. Then we have seen the executing authority, the body that oversees and approve the resolution process, right? So this thing. Now let's move on to the next question. Let's see what type of question are being asked in the examination. So question number 2, which of the following is appropriate in the project appraisal? Friends, if you are preparing for CCP, obviously you are preparing for CCP, then you can join our Telegram channel where you can find such type of questions. The link of Telegram channel is provided in the description section. So you will get exposure to what types of more questions are being asked in the examination. Okay, there are almost 500 people who have already joined the Telegram session, so you can take help of their experience also. Now let's see the next question. Which of the following is inappropriate in the project appraisal? So the question is in which of the following is inappropriate in the project appraisal? The first is checking the borrower background. Option 2 says that verifying transaction check on a regular basis. Option 3, assessing the borrower's payment capacity, and option 4, evaluating cash flow for the project. So which is inappropriate? So let's see the first option, that is checking the borrower background. So this is the standard part of project appraisal. Lender need to assess the borrower credibility and past financial behavior to minimize the risk. So imagine you are lending money to a friend. Would not you want to ensure that they are trustworthy and have repaid debt in the past? So that is what this is a part of the project appraisal. Verifying transaction check on a regular basis. So this VTC, it is also called VTC, that is verifying transaction check on regular basis. See, this is inappropriate for project appraisal. While monitoring transaction is essential during project implementation, it is not part of the initial appraisal process. The focus of the appraisal is on feasibility. The focus on the appraisal is on feasibility, not day-to-day transaction. This is the main focus, not day-to-day transaction. Think of this as trying to monitor a project daily cash flow even before deciding to fund it. It does not make sense, right? The third option says assessing the borrower payment capacity, right? So what do you think about this? This is the crucial part. Understanding if the borrower can repay the loan ensures the lender's money is used wisely, right? Obviously borrower payment capacity plays a crucial role. And let's see the fourth option. So I can give you example to make option 3 more clear. It's like checking if someone can afford a loan before approving it. And option 4 says evaluating cash flow for the project. So this is the key part of project appraisal. Lender need to ensure that project can generate sufficient cash flow to repay the loan and sustain itself. It's like ensuring a business plan is profitable before investing it. So what is the correct answer? The correct answer is option number 2. So this is the correct answer, verifying transaction check on a regular basis, right? So what is the key takeaway from this particular question? So we have seen that checking the borrower background and payment capacity is essential to minimize lending risk. Evaluating cash flow ensure the project financial feasibility. And third thing we have seen, verifying transaction check is not a part of appraisal stage. It is relevant during the project implementation phase. Now let's move on to the next question. So let's see what is the next question that we have. As on now, how many core investment, I think CIC, credit investment company, for the, this is not the correct full form, I think it is credit information company, right? CIC means credit information company. So let me correct it. How many credit information company have been declared by RBI at the domestic level? So at the domestic level, you know, at the domestic level and at the international level, there are different types of CICs. So you have been asked to find how many CICs are there at the domestic level. So now the correct answer is 4. There are 4 CIC. Okay, let me name them. Let me provide you the name of them also. So you can see these are Credit Information Bureau Limited, that is called CIVIL. We call it CIVIL. CIVIL full form is Credit Information Bureau India Limited. And then after we have Equifax, right? Equifax. So Equifax Credit Information Service Private Limited. This is the second one, Equifax Credit Information Service Private Limited. First is CIVIL. The third is Experian Credit Information Company of India Private Limited. And the fourth is CRIF Highmark. So these are the 4 CICs in India, right? Credit Information Company. Now let's see the next question. Is ROC, you know what is ROC? ROC is Registrar of Company. Is ROC filing compulsory for LLP, that is Limited Liability Partnership? So the question is whether ROC filing, you know, every partnership has to registered with ROC. So whether it is compulsory for LLP also or not. So option, let's see the option. The first option say no for unregistered LLP, it is not mandatory. See, this is wrong. There is no concept of unregistered LLP, because an LLP must be registered under the Limited Liability Partnership Act 2008. You must remember it. This registration is mandatory. It's like saying you are part of a club without officially signing up. That does not work. Now, sir, option 2 says that only bank consider ROC for LLP. This is also incorrect. While bank may check ROC filing for verifying an LLP compliance, registration with ROC is a statutory requirement under the LLP Act, not just for bank. Registration with ROC is compulsory for LLP. This is the correct one, right? See, filing with ROC is mandatory for LLP. It ensures legal recognition and compliance with regulation, such as filing annual returns and financial statement. Imagine you are starting a business as an LLP. Without registering with ROC, your LLP cannot legally exist or operate. Option 4 says filing with ROC is optional for LLP. This is incorrect. Filing with ROC is not optional. It is a legal requirement for LLP to maintain their status and avoid penalty. So what is the correct answer? Option number 3 is the correct answer. So let me just summarize the key fact which we have covered just now. That registration with the Registrar of Company, that is ROC, is mandatory for all LLP under the Limited Liability Partnership Act 2008. Filing with ROC ensure that LLP is legally recognized and remain compliant with a statutory requirement like filing annual returns. Non-compliance can lead to penalties and legal issues for the LLP. Right. So this is about ROC and LLP condition. Now let's see the next question. A company has the following financial ratio. So this is a good question based on numerical part which have been asked in the examination. So you have been provided the financial ratios like current ratio given 1.5, quick ratio is given 1.2, inventory turnover ratio is given 6, current liability is given 1 lakh. You have to find the COGS. What is COGS? Cost of goods sold. So now let's first calculate step by step. So you know the current ratio. What is the formula of current ratio? It is nothing but current asset upon current liability. Okay, now see, it is given 1.5. So 1.5 will be how much? Current asset upon current liability, and current liability is 1 lakh. So you can say current asset will be how much? 1.5 times CL, or you can say 1.5 times 1 lakh. So this will be how much? 1,50,000. So this will be our current asset. Okay, now we know the current asset. Now let's move on to the quick ratio. Let's take help of this quick ratio. What is the formula of quick ratio? Let me write down here. That is nothing but quick asset upon current liability, and this is given 1.2. So 1.2 is equal to quick asset upon, and current liability is 1 lakh, right? So how much will be the quick asset? So the QA will be 1.2 times 1 lakh. So this will be how much? 1,20,000. So quick asset is given 1,20,000, current asset is given 1,50,000. Okay, now what is the difference between the quick asset and the current asset? You know, see, quick under current asset also includes inventory. So you can say current asset is equal to inventory plus quick asset. Okay, so the difference is inventory. So can you tell me what will be the inventory value here? You can say inventory is equal to current asset minus quick asset. What is the current asset here? That is 1.5 lakh. And what is the quick asset here? 1.2 lakh. If we subtract, this will give you 30,000. So 30,000 will be the inventory. Now we know the inventory. Okay, and one ratio is also given, inventory turnover ratio. Let me erase it up. I think there is no space, so let me erase it and I will do the further calculation here. So what is inventory turnover ratio? Tell me, what is inventory turnover ratio? You know the formula? Let me remind you. I think you know the formula. Inventory turnover ratio, ITR, is equal to COGS upon inventory. This is simple formula, right? So we know ITR, inventory turnover ratio, is given to us 6. So in the place of ITR we will write 6. COGS we have to calculate, that is cost of goods sold, and we know the value of inventory, which is 30,000. So let me write here 30,000. So what is the COGS? So COGS is nothing but 30,000 multiplied by 6, which is 1,80,000. So I think there is no option here, but suppose there is a fifth option, that suppose there is a fifth option here, that is 1,80,000. So that would be the correct answer, right? 1,80,000. Okay, so hopefully you have understood this particular concept. Okay, inventory turnover ratio, how to calculate this COGS, this is how you have to go do it. Okay, now let's see the next part. What is the maximum period for which packing credit in Indian rupees can be extended to exporter as per RBI guideline? Friends, before going to the option, let me tell you that if you are looking for study material for CCP, in our app, that is JIV and CIV Made Simple app, you will find an exhaustive study material for CCP, in which we provide unit-wise theory, unit-wise MCQs, as well as previous year questions. All these things are available in the form of PDF, which is completely downloadable, and you can take print for offline reading also. So in the link beside in the description section, I have provided you the course link. You can directly go to the course and you can get each and every unit's theory portion, concise notes, complete MCQs, which will help you revise the concept. For more detail, you can WhatsApp me on this particular number also. Now let's see the next question. Question is, what is the maximum period for which PCIR, that is packing credit in Indian rupees, can be extended to exporter as per RBI guideline? Tell me, what is the maximum number of days? So PCIR can be extended to the exporter as per RBI guideline. What is the maximum number of maximum period? So options are 120, 180, 360 and 90. See, first of all, let's understand what is PCIR. Packing credit in Indian rupees. PCIR is a short-term pre-shipment credit. It is a type of pre-shipment credit. It is a type of pre-shipment credit provided to the exporter. It helps exporter finance activities like purchasing, processing, manufacturing or packing goods meant for export. If we talk about the duration, so RBI allowed packing credit for a maximum period of 180 days. For the maximum period of 180 days, this is allowed. Okay, from the date of disbursement. Date of disbursement to 180 days. Okay, if additional time is needed, bank can consider extension in exceptional case, but these may require RBI approval, compliance with the specific guideline. So the common duration is 180 days. Okay, now the second question is, why duration is capped at 180 days? This time frame ensures that exporter have sufficient time to process good and ship them, right? It also aligns with typical export cycle, ensuring liquidity without overstanding credit. So extension beyond 180 days, there are some exception also. It's not hard and fast that only 180 days. Yeah, exception also there. Extension beyond 180 days are rare and subject to a strict regulation. Exporter must demonstrate valid reason. Like, let me give you an example to make this concept more clear. Imagine you are an exporter of textile. Okay, you are an exporter of textile. You take PCIR from the bank. You avail the packing credit exposure from the bank to purchase raw material and prepare the shipment. As per the rule, you need to complete your shipment process within 180 days to repay the loan, and if there is an unforeseen delay, you will need to apply for an extension through your bank, which will then follow RBI approval process. So what are the key takeaway from this particular question? We have seen what is the purpose of PCIR, that a short-term credit to help exporter with pre-shipment activity like purchasing and packing goods, and we have seen the maximum duration, which is 180 days from disbursement, and we have seen extension is also possible, right? So that is everything you need to know about PCIR. If you really find this explanation useful, give this video a like, share it with your fellow learners, and subscribe to the channel for more such insight. Let's continue to the next question. So let's see what is the next question here. The next question is, as per the Tandon committee recommendation, which method gives the highest MPVF? You know MPVF, maximum permissible bank finance. So there are certain method, first method, second method, third method, and fourth method. Okay, so which will give you the highest MPVF? So first of all, what is the Tandon committee? Let me give you a glimpse. The Tandon committee was set up to suggest way to regulate working capital financing by a bank. So main key factor is working capital financing by a bank. Okay, its main goal was to ensure that company use fund efficiently while reducing over dependence on bank credit. So that is about the Tandon committee. The second thing is MPVF. What is this MPVF? MPVF refers to the maximum amount bank can lend to business for its working capital need. The maximum amount that bank can lend to the business for working capital need is called MPVF. This committee suggested three methods to calculate MPVF. So what is the first method? What does the first method says? Okay, you will get answer if you know these four methods. If you know what these four methods are, you will clearly get the answer. The first method says that bank finance 75% of the working capital gaps. WCG. What is WCG? This is the difference between the current asset and current liability, or the CLO BB say, which is nothing but current liability other than bank borrowing, right? So this is what, so 75% of the WCG will be provided by the bank, and 25% will be provided by the it will be provided by the borrower, which is called borrower contribution, which is also called margin. So this is more restrictive because the borrower contribution is higher. What is the question asking? Question asking you to find which method give the highest MPVF. In which method bank will give the highest permissible finance. So it is not the correct answer. It is restrictive because borrower contribution is higher. Let's see the second method. In the second method, you know that borrower contribute 25% of the current asset and the bank finance the balance. So 25% of what? 25% of current asset. Since the borrower margin is fixed at 25%, the bank share increases. So that is why, as compared to the first method, in the second method we have higher MPVF, right? In this method we have higher MPVF. If we talk about the third method, so borrower contribute 25% of the core current asset, 25% of the CCA, core current asset. What is CCA? Maximum current asset required to operate a business. What is CCA? This is the maximum current asset required to operate the business. This is called CCA. Okay, so and the bank finance the remaining. This method is stricter as it focus on core asset only. So option D says all method give the same MPF. This is incorrect. Now the correct answer is option number B. So the question is why the second method gives the highest MPVF? See, we have fixed the borrower contribution to the 25% of total current asset. We have just fixed it in the second method. So the bank share increase. In this case, bank share will increase. Okay, and it allows for a larger loan compare as to the other method. So let me give you an example to explain it. Let's suppose company needs 1 lakh. Company needs 1 lakh for working capital. According to the first method, bank finance 75%, which is 75,000, and the borrower will finance the rest 25,000. Okay. According to the second method, borrower contribute only 25,000 and bank finance the remaining. Right. So in terms of margin and flexibility, second method result in higher MPVF. Okay, so that's the point. Now the next question is, here it is, it has explanation is also there. In this way you will find explanation for each and every question. MCQ is also. Now the question is, who can initiate the CIRP? What is CIRP? Corporate Insolvency Resolution Process under the IBC, Insolvency and Bankruptcy Code 2016. Who can initiate this CIRP under the IBC? Tell me. Options are only principal creditor, financial creditor and operational creditor, only operational creditor, all of the above. So first of all, what is CIRP? Okay, because we are dealing with CIRP, what is CIRP? So CIRP stands for Corporate Insolvency Resolution Professional Process. It is a mechanism under the IBC to resolve case of corporate solvency. If we have to resolve cases of corporate solvency, corporate insolvency, in that case CIRP is used. So it is a legal process initiated when a company is unable to pay its debt, and it aims to revive the company or liquidate its asset to repay the creditor. Okay, so this is about the CIRP. It is a legal process when the company is unable to pay its debt, and its aim to revive the company or liquidate its asset to repay the creditor. Okay, so question is, who can initiate CIRP? Under the IBC 2016, the following entities can initiate CIRP. The first is FC. FC means financial creditor, a creditor who has provided a financial loan or credit to the corporate debtor. Okay, so for example, bank or financial institution who have provided loan to the to this particular debtor. Okay, so company is not able to paying its debt, and it aims to revive the company or liquidate its asset to repay creditor. Now the first, financial creditor. Second is operational creditor can also initiate CIRP. What is operational creditor? A creditor owed money for operational activity like unpaid supplies, vendor, service provider. For example, a logistic company unpaid for its service. This is example of operational creditor. And the third is corporate debtor. So the corporate debtor can also initiate the CIRP. Corporate debtor. So the company or debtor itself can voluntarily initiate CIRP if it is unable to pay its debt under the voluntary insolvency provision. This is typically done to seek legal protection and work toward resolution. So what about the principal debtor? The principal debtor cannot initiate CIRP on its own unless it is filing as a corporate debtor under voluntary insolvency provisional. So let's suppose, let me give an example. Suppose there is a company named ABC Limited. It owes 5 crore to a bank. Okay, so this bank will be what? This bank will be financial creditor. Suppose it owes 50 lakh to a supplier. Okay, it owes 50 lakh to a supplier, so this supplier will be operational creditor. Suppose in this, let's consider the first scenario. The bank can initiate CIRP as the financial creditor due to unpaid loan. Scenario 2, this particular supplier can also initiate CIRP as an operational creditor due to non-payment of the dues. So this is OC, this is FC, both of them can initiate CIRP, and this corporate debtor can also initiate the CIRP, right? But the principal debtor cannot initiate CIRP unless filing as a corporate debtor. So this process ensures transparency and fairness for all stakeholders involved. Now, so hopefully you have understood this particular concept. Now let's move on to the next question. The next question is, as you can see, yeah, this is a very good question. A company has sales of 24 lakh. I think, yeah, 24 lakh at 200 rupees per unit. The break even point is 50% of the sale, and the profit volume ratio is 25%. You have to find the fixed cost. Okay, sales is given, break even point is given, profit volume ratio is given, and you have to find the fixed cost. So here you should know what is the formula for the profit volume ratio. This question is quite simple. You just have to substitute the value, right? You will get the answer. So what is given? Break even point is 50% of the sale. And how much is the sale? Sale is given 24 lakh. So can you tell me what will be the BEP? So BEP will be 50% of 24 lakh, isn't it? It's 50% of 24 lakh. What will be the 50% 24 lakh? 12 lakh. So BEP will be 12 lakh. Okay, and now PYV ratio is given how much? PYV ratio is given 25%, or we can say 0.25, either 25% or 0.25. Now first of all, you should know the basic formula to compute it. The formula is quite simple, that BEP, break even point, is equal to fixed cost upon PYV ratio. Okay, BEP is equal to fixed cost upon P by V ratio. So what is BEP? You know, let me give you how this formula came. Let me just remind you. So suppose this is our sales. One part of the sales is variable cost, you know very well, and the other part of the sales, this is called contribution, right? This is called contribution, right? And contribution, inside contribution you will get what? You will get two parts. One is the profit and other is the fixed cost. So at, you know, at BEP, no profit is there, so contribution will be equal to fixed cost, you know it very well, right? At BEP, the point at which BEP held, there is no contribution, sorry, there is no profit. Okay, so our entire contribution will be borne by the fixed cost. So if we multiply this BEP with P by V ratio, this will give you contribution. That's how this formula came, right? Instead of this contribution, you can write BEP times P by V ratio. BEP is what? Number of units. It is nothing else but number of units, and P by V ratio means profit volume ratio. Okay, so this is how this formula came, and now you just have to substitute the value. Okay, you have to, so you can see here in this particular formula, you can see, you can write, just let me erase it. Okay, we have got BEP 12 lakh. Let me erase it, and I will do the calculation, risk calculation here. So so you have to find the FC, right? So FC, you can say it is nothing but BEP multiplied by P by V ratio, isn't it? So what is BEP here? BEP here is 12 lakh, and what is the P by V ratio? It is nothing but 0.25. So or you can say 1/4. So what is the 1/4 of 12 lakh, right? So here it is 1/4, or you can say 1/4. I think it is 3 lakh, right? 1/4 is 3 lakh. So the correct answer is 3 lakh. So fixed cost is 3 lakh. Let me see the option which correspond to 3 lakh. So I think no option is given, but let's suppose option number E is there, 3 lakh. So 3 lakh is the correct answer. So let me just again summarize the fact which we have learned in this particular question. Break even point is the level of sales at which there is no profit or loss. P by V show the contribution margin as a percentage of the sale. I already told you, it shows you the contribution margin, right? Contribution margin as a percentage of the sale. So that's why P by V, if you multiply with BEP, this will give you the contribution. And fixed cost calculation, use the BEP and P by V ratio, right, to find fixed cost when sales details are provided. So this is how you have to calculate this. Now let's see the next question that we have. The next question is, the limited liability partnership is established under which statute? So very good question. LLP, the question is regarding the LLP. So LLP is established under which statute? Options are Companies Act 2013. Yeah, this is wrong. See, first of all, if you know about limited liability partnership, so this is a unique business structure that combines the advantage of both a corporate structure and well as partnership. You know about it? It combines the advantage of both corporate structure as well as partnership, right? This is a unique feature of this LLP. So it offer limited liability to its partner, meaning their personal asset are protected. That is called limited liability. Okay, unlike in traditional partnership where the partners have unlimited liability. In traditional partnership, you know, the partners have unlimited liability, while in the case of limited liability partnership, their assets are protected. The LLP Act 2008 governed the establishment, management and operation of the LLP in India. So the correct answer will be option number C. The next question is, why other options are incorrect? First option say Companies Act 2013. Say this act governed the incorporation and regulation and dissolution of company, not LLP. So Indian Partnership Act, this act deals with general partnership which does not provide a limited liability feature. And last is Society Registration Act. So this act pertains to the registration of society. So what is the key takeaway from this particular question? We have seen that LLP are governed by the Limited Liability Partnership Act 2008. It combined limited liability with the flexibility of a partnership structure. It is distinct from a company and traditional partnership. Hope that things clear up. Now let's see the next question. What is the green clause LC? Okay, the next question was asked, what is the green clause letter of credit? You have been provided with the four option. Okay. First option say, first of all, let me provide you explanation. A green clause LC is a specific type of LC that allows the exporter to receive advance payment for certain goods, certain cost before the shipment of the goods. Okay, so you will receive the advance payment means exporter. You will not. Exporter will receive the advance payment for a certain goods. Okay, and the advance payment is specifically for storage and processing of goods. You will receive advance payment, but what it is for? It is for the storage plus processing of goods, right, ensuring that exporter had necessary fund to take care of the goods before they are shipped in. This is particularly useful in scenarios where goods need to be stored or processed for significant time before shipment. It happened that in some product we have to store the goods, we have to process the goods for a significant time before shipping them, and for such cases this green clause LC is a superior, plays a fruitful role. Now let's see what are the other option. First option A say that LC that allow advance payment for storage and processing of goods, correct. And LC that restrict parcel shipment, this is wrong, because this describe the red clause LC. You know about red clause LC, which can restrict parcel shipment, not the green clause. An LC that mandate payment only after the final inspection of goods, so this is more aligned with the site letter of credit. Okay, and last option says NLC used exclusively for agriculture purpose. I think green clause LC not restricted to agriculture purpose. So what we have learned in this particular question, that the green clause letter of credit helps the exporter by providing advance payment for storing and processing goods. It reduces the financial risk for exporter, and this type of LC is highly beneficial in cases where goods require extra time for handling before delivery, right. So this is a key fact about the green clause letter of credit. Now let's see the next question. Which of the following best describe an English mortgage? So options are given. You can see four option is there. Option A says that the mortgagor transferred the property conditionally without any personal liability to repay the loan. Option B says that mortgagor bind himself personally to repay the mortgage money on a specific date, and the property is absolutely transferred to the mortgagee with a condition for reconveyance upon repayment. The mortgagor retained full ownership of the property but provide the mortgagee with a lien until repayment. Option D said that mortgagee has right to sell the property without transferring ownership during the loan term. So tell me which statement best describe English mortgage? So first thing, English mortgage is one of the traditional form of mortgage. It is unique in the fact that the first is mortgagor, right. So mortgagor means borrower. So borrower bind himself personally to repay the loan. Borrower binds personally to repay the loan, and the property is absolutely transferred to the mortgagee. Property is transferred to the mortgagee. Who is mortgagee? Mortgagee is lender. Property is transferred to the lender with a condition that property will be reconveyed to the mortgagor once the loan is repaid, and it involves full ownership transfer to the lender, but upon repayment the mortgagor get the property back, right. Now why are the other option incorrect? So let us go to the option. Option A said that the mortgagor transferred the property conditionally without any personal liability to repay the loan. So this describe a conditional sale. It describe a conditional sale, not an English mortgage. In an English mortgage, the mortgagor bind himself personally to repay the loan, right. Option B says that the mortgagor bind himself personally to repay the loan. Correct on specified date, and the property is absolutely transferred to the mortgagee with the condition for reconveyance upon repayment. Yes, correct. This is exactly what English mortgage is all about. Option C says that the mortgagor retained full ownership of the property but provide the mortgagee with lien until repayment. What do you think? See, this is refers to the simple mortgage. See, it is quite essential to see each and every option because other option provide you a concept. So this is the concept of simple mortgage. So suppose question is what is simple mortgage? So this option will be correct. The mortgagor retain the full ownership of the property but provide a mortgagee with lien until repayment. Yes, correct. So in the English mortgage, the mortgagor transfer full ownership to the mortgagee, unlike in simple mortgage where only lien is provided. And last option say mortgagee has a right to sell the property without transferring ownership during the loan terms. So tell me whether it is English mortgage? No. This describes the power of sale clause. It describes the power of sale clause which is typically found in mortgage like the English mortgage, but it does not accurately describe the essence of the English mortgage. So the key feature is transfer of property with the condition of reconveyance. So let us quickly revise what we have learned in this particular question, that in English mortgage, the mortgagor transferred the property to the mortgagee and bind themselves personally to repay the loan, right. And upon repayment, the mortgagor can have the property reconveyed to them. The mortgagee has absolute ownership of the property until the debt is clear, right. So friends, so a bank financial shows the following figure. So bank credit in India is 12,000. I think all the data are in crore, right? All the data are in crore. so 12,000 crore. Then we have bill discounted 1200 crore. Outstanding deposit under RIDF, NABARD, NHB, SIDBI and Mudra 1500 crore. Outstanding PSLC 500 crore. Exemptions on long term bond for infra and affordable housing, it is 1800 crore. Investment in recapitalization bond, right? Investment in recapitalization bond, it is 400 crore. Advance against incremental FCNRB or NRD deposit 700 crore. Please take a screenshot of this slide because the data we will be using to solving the numerical. This thing will be provided in the examination. Then the next thing is given that investment in securitized asset, as you can see, is 300 crore. Then we have face value of STM security under TLTRO and SLMF, it is 1000 crore, and bond debenture in non SLR category under STM category 600 crore. Now let's see the question. So this data have been given. I request you to please take a screenshot of it. What is the ANBC of the bank? Right, 4 option has been given. What is the adjusted net bank credit from the bank? So let us calculate each and every step by step. How do you go about calculating it? Right. So friends, let us calculate it step by step. So these data have been given, right? So first of all, you must know that what is the formula for calculating net bank credit. Do you know the formula for calculating net bank credit? So let me write it down. So the formula for calculating net bank credit, NBC is called net bank credit, is equal to bank credit in India minus bill discounted, right? Minus bill discounted. Now please tell me what is the bank credit in India? It is 12,000. So just write 12,000. And what is the bill discounted? It is 1200. So just subtract it, 1200. So this will give you how much? This will give you 1800 crore. Right, 1800 crore. Now think of this is called NBC, net bank credit. Think of this as the bank net lending after excluding the credit it has already sold or rediscounted with other financial institution. Means the bank net lending, you can think of them as the bank net lending after excluding the credit it has already sold or rediscounted with other financial institution. Then what you do, you add the RIDF deposit and PSLC, you add these two, right? So what is RIDF deposit? 1500 crore. What is PSLC? 500 crore. So total will be how much? Total will be 1500 plus 500. So this will give you how much? 2000 crore, right? So now the new total is how much? New total is 1800 crore plus 2000 crore. So this will be how much? 12,800 crore, right? Now this is the step number 2. So in step number 2, what we did, we add the RIDF deposit and we add the PSLC. So these two have been added and this has been subtracted. Now after step number 3, that we add exemptions for long term bond. So bank get exemptions for issuing long term bond meant for infrastructure and affordable housing. So we will add this. So 12,800 plus how much? Plus 500, right? So no, it is 1800, right? So this is the exemption. So 12,800 plus 1800, so this will give us how much? 14,600 crore, right? Now then what we will do, then the next point we have is to subtract exemptions and investments, right? So now you can see advance against incremental FCNR and RD deposit. So these are the kind of exemptions which is given. It is how much? 700 crore, right? And this investment in recapitalization bond, this is also kind of investment. So this is 400 crore, and investment in securitized asset is also 300 crore. So if you add all of them, it will amount to 700 plus 300 plus 400. So this will give you how much? It will give you 1400. So this you have to deduct. So total deduction is 1400 crore, right? So the new total will be how much? The new total I am writing here, 14,600 minus 1400. So this will give us 13,200 crore. So these things have to be subtracted, right? Now HTM security has to be added because which is the face value of held to maturity under TLTRO, SLMF. So you have to add these two, right? So you have to add these two. So you can see 1000 crore has to be added. So just add 1000 crore, it will become 14,200 crore. Now the final thing is that you have to subtract bond in non SLR category under STM. So which is how much? 600 crore. So you subtract 600 crore. The final answer is how much? 13,600 crore. right? So this is how you calculate the A and BC. Now let's analyze each and every option. So first of all, you must know what has to be added, what has to be subtracted. Please take a screenshot of this slide. This will help you know that this thing have to be subtracted and this thing have to be added in order to compute A and BC. And this question is most frequently asked in every CCP examination, right? So let's go through the option. Option number C is the correct answer, right? So the correct answer is option number C. So let me summarize before we wrap up. Here are the key points to remember, right? So there is a formula to calculate A and BC. And what is the formula? Let me show you the formula, right? So let me write down the formula of A and BC. What to add, what to subtract. So first of all, you calculate the NBC. First of all, you add the NBC. You add it RIDF or PSLC. Then you add the exemptions. Then you subtract the deduction. Then you add the STM security. Add the STM security, and then you subtract the non-SLR bond. Right. So this way you have to compute A and BC. Right. So this is the formula for A and BC. So the key components here are RIDF and PSLC. These are added. Remember, RIDF and PSLC are added. Long-term bond for infra and affordable housing are added at exemptions. So this exemption includes, long-term bond, which is given for infrastructure and affordable housing. And deduction include, advance against FC and RB. So whatever advance has been given against FC and RB, and whatever advance has been given against NRE deposit, recap bond, this has to be deducted. Right. So carefully consider addition and deduction. Missing even one component can lead to incorrect answer. So this is how you have to compute the A and BC. Please remember the formula. This will help you compute it. Now let's see the next question. The question number 2 is on your screen. I request you to please try to solve this question yourself. This question is based on diversion of the fund. Very important question it is. So let's go through each and every option and understand which option is correct one. So friends, let me see you the question. A bank earmarked 100 crore exclusively for priority sector agriculture lending as per the regulatory guideline. During the year, the bank disbursed only 75 crore, right? Only 75 crore was disbursed for agriculture lending, while the remaining 25 crore, was allocated to corporate non-priority lending. Now we are asked, what is the amount representing the diversion of fund? 0 crore, 25 crore, 75 crore, 100 crore. So first of all, what you must understand, what is the meaning of this term earmarking, right? So first let's clarify what is the meaning of earmarking of fund. The bank set aside 100 crore specifically for priority sector lending in agriculture. Think of it like allocating a monthly budget of rupees 10,000 for grocery. You expect to expend the entire amount only on food item. Now, however, the bank only lent rupees 75 crore to the agriculture, meaning rupees 25 crore is not used for the intended purpose. Instead, this 25 crore is diverted to non-priority lending, which is a corporate lending, which is a non-priority sector. It's like you plan rupees 10,000 for grocery, but only 7,500 on food, but only spend 7,500 on food and remaining 2,500 for online shopping. So can you tell me what is the diversion? So obviously the diversion which has been asked to you is how much? So diversion is equal to 100 crore which was earmarked and minus 75 crore. Minus 75 crore. What is 75 crore? Because this 75 crore is the actual disbursement. So this was the earmarked amount. This is the actual disbursement. The answer is 25 crore. Right. So let's go through each and every option. So option number B is the correct answer. Right. So what we learned from this discussion, that earmarking of fund, whenever bank reserve money for a specific purpose, it should be used only for that purpose. Right. And diversion formula is quite simple. What you have to do, you have to subtract earmarked fund and actual disbursement. This will give you the diversion, right? So that is our answer. Very easy question it was. Right. Friends, if you are preparing for CCB and if you are looking for study material for the same, so let me show you study material on my app JIB and CIB Made Simple. I have made a course in which you can see that I have added 3 previous year questions, right? So you can see this is how the course look like. And offer module wise, module A, module B, module C, module D and module E. If you open a single module, like suppose I open module A, so there are different unit in module A, like unit 1 principle of lending, unit 2 credit policy, and inside each every unit you will get separate theory PDF and separate MCQs PDF. Like suppose I open module unit 1, so you will get separate theory PDF and MCQ PDF. So friends, this way it has been arranged. So if you want to get access to such kind of material, you can WhatsApp me on this particular number I am writing on the screen, right? And you can also join our Telegram channel, in which different candidates have already joined, and they pose the memory based question. The description of the Telegram channel is provided in the description section of this particular video, right? Now let's see the next question. The next question is on your screen. As you can see, this is a very important question. Let's go through it. So friends, the question asks that an exporter has received a PCFC facility. You know PCFC? That is called pre-shipment credit in foreign currency. Exporter has received a PCFC facility from a bank with the following condition. The facility offers competitive rate linked to LIBOR, Euro LIBOR or Euro LIBOR. Exporter can choose to avail of PC in rupees or directly in foreign currency, right? Cross currency PCFC is allowed, right? Cross currency PCFC is allowed, and the PCFC is carved out of the normal PC limit. So let's see the question directly. No need to go through each and every option. Which of the following statements regarding this PCFC facility is not correct? Right. Option number A, exporter can avail of PCFC in one convertible currency for an export order invoice in other convertible currency, although the risk of cross currency transaction is borne by exporter. Option number B, the PCFC facility is subjected to separate limit apart from the normal PC limit sanctioned by the bank. The option number C, the rate of interest on the PCFC should not exceed 350 basis point over the applicable LIBOR. And option number D, for non-standard credit period, the applicable rate of interest is determined by using the rate for the next or upper standard period. So friends, these are the four options, and which is not correct have been asked. So let's go through each and every option. So friends, you know what is PCFC? So basically, let me explain a little bit about the option. So first of all, let's understand what is PCFC basically. So PCFC stands for pre-shipment credit in foreign currency, right? It is a loan facility given to exporter so it is a loan facility given to whom? To exporter, right? It is loan which is given to exporter to finance their working capital need, right? To finance their working capital need, like buying raw material, processing, packaging before shipping the goods. So instead of taking a loan in rupees, exporter can avail in foreign currency, right? So that is why FC word is written there, foreign currency, like dollar, euro, Great Britain pound. Why? Because foreign currency loan have a lower interest rate, making them cheaper for exporter. And interest rate are linked to LIBOR, which is London Interbank Offer Rate or Euro LIBOR. Now let's analyze each and every option one by one. So first of all, let's go through option number B. It says that PCFC facility is subjected to separate limit apart from the normal PC limit. Under the PCFC scheme, there are no separate limits. So this option is wrong. This facility is carved out of the bank existing PC limit sanctioned to the exporter. It's like having a single wallet for shopping, whether you pay in cash or you pay in card. You are spending from the same wallet. Similarly, PCFC is not an additional limit. It comes out of the already approved pre-shipment credit limit. Hence, this is incorrect option. Right. Option number A, exporter can avail of PCFC in one convertible currency for an export order. Yes, correct. Because in cross currency PCFC, there is a kind of called cross currency PCFC. So in cross currency PCFC, exporter can borrow in one currency, let's say dollar, even if the export order is invoiced in other currency, let's say euro. However, exporter bear the currency risk, which means if the exchange rate fluctuates unfavorably, the exporter may incur a loss. So let me give you an example to make it more clear. For example, suppose you take PCFC loan in dollar, right, for an export order this export order is invoiced in suppose euro, right? So if the USD is strengthened against dollar, suppose US dollar strengthened against euro, right? So by the time you receive the export proceed, you will end up receiving fewer dollar when converted, reducing your earning. So this option A is correct. Option C says the rate of interest should not exceed 350 basis point over the applicable LIBOR. Yes, this is also correct, because under PCFC scheme, the maximum interest rate that bank can charge is 350 basis point above LIBOR. So what is the meaning of basis point? So 1 BPS, 1 BPS is equal to 0.01%. So here 350 BPS means 3.5%, right? So option C is correct. So A is correct, C is correct, B is wrong. And option number D says that for non-standardized credit period, the applicable rate of interest is determined by using rate for the next. Yes, this is also correct. Bank offer PCFC loan for a standard tenor. There is something called a standard tenor. 1 month, 2 month, 3 month, 6 month or 12 month. These are the standard tenor. For non-standard period, let's say 4 month. Suppose 4 months. So this 4 month is not a standard period. For non-standard period, the interest rate of the next higher standard period is charged. So let me give you an example to make option D more clear. Let's say that you have availed PCFC for 4 months, right?
So the bank will apply the interest rate for 6 months, which is the next higher period. Understood? So option D is correct. So the correct option to this question is option number B, not correct have been asked, right? So what we learned from the discussion is that the key learning from this discussion is that PCFC, first thing is that PCFC is a pre-shipment credit, first thing, right, for exporter. So for first point you must make it clear that this is the kind of pre-shipment credit, right, and it is offered in foreign currency, and it is linked to the LIBOR or Euro LIBOR. Second point, cross currency PCFC is allowed, but the exporter bear the exchange rate risk. Interest rate on PCFC cannot exceed 350 basis point, and no separate limit are required for PCFC. It is carved out of the normal pre-shipment credit limit, and for non-standard tenor, bank apply the interest rate for the next higher standard period. If you find this concept helpful, if they find the video helpful till now, please hit the like button, right? This will motivate me to make more such and such content, right? So now option B is correct to this particular question. Now let's see the next question on gold card scheme. This question is most frequently asked, right? So let's go through the question. So some statement has been provided to you, right? So friends, the gold card scheme, option number A says that it was introduced by RBI, right? So some statements are there. Statement number 1, eligibility. Only exporter with a minimum track record of 3 years who have continuously maintained a standard performance with no irregularity are eligible for gold card. Statement number 2, gold card holder are given preference by bank for granting packing credit in foreign currency and may also be considered for term loan in foreign currency using FCNR fund. Statement number 3, the in principle credit limit is sanctioned for a period of 3 years and is automatically renewable provided the exporter comply with the loan term. Statement number 4, processing charge on loan for gold card holder are lower than those for other exporter, and a flat service charge of 0.1% is applied on interbank foreign currency borrowing. And statement number 5, that a standby limit of not less than 20% of the assets limit is available for urgent credit need. Right. So these are the 5 statements. Now which combination of statement is correct? So in this question we will able to cover every part of gold card scheme. So which statement is correct? A statement option number A, 1, 2, 3 and 5, 4 is incorrect. 1, 2, 3 and 5. So I think yes, so it's easy. 1, 2, 3 and 5 are correct, 4 is incorrect. 1, 2, 3, 5 are incorrect, 4 is correct. Right. And only 1 and 2 are correct. All statements are correct. So these are the 4 options which is given. So now let's go through each and every statement. So friends, gold card scheme is an RBI initiative, first thing, right? And it is a priority financing and lower charge to the exporter. It offer priority financing and the lower charge to the exporter, right? And it faster loan processing and longer credit validity. So you can think of like a VIP membership for exporter where they get faster service, better rate. Now let's analyze each statement. So first statement says that only exporter with minimum track record of 3 years, right? This statement is correct. Right, to be eligible for gold card, you must know that it should have a clean track record. It should have a clean track record of 3 years, right? At least 3 years, and there should be no default, no irregularity. So exporter who are blacklisted by ECGC, right, or on the RBI defaulter list or incurring loss for 3 consecutive years are not eligible. Very good, it is correct. For example, imagine you run an export business and have been regularly repaying loan on time for past 3 years. So you qualify for gold card. But if you have defaulted or made losses in the last 3 years, then you won't be eligible. So this is the point. Now let's look at statement number 2, credit preference and flexibility. So this statement is also correct because the gold card holder get preferential treatment from bank, meaning they are given priority for packing credit in foreign currency PCFC. Yes, they get priority. Right, they get priority in PCFC, and also bank may grant them term loan in FC, right, using FCNR fund, and the loan limit is based on their expected export turnover, making it more flexible. So if you are a gold card holder and you apply for foreign currency loan, the bank will prioritize your application of a non-gold card holder. So this is also correct. Now statement 3. So under the gold card scheme, the bank sanctioned a credit limit for 3 years. This is correct, right? And if the exporter follow the loan terms, the limit is automatically renewed. The limit is automatically renewed without the need for reapproval. So suppose, let me give you an example. Suppose you are an exporter with gold card and sanction limit of 10 crore, right, for 3 years. So if you repay on time, if you repay the amount on time and follow the rule, the bank will automatically extend the limit without additional paperwork. So this is also correct. Till now we have seen 1, 2, 3 are correct. What about option number, statement number 4? So this is also correct. It says that gold card scheme offer a standby limit of at least 20% of the access limit for urgent card need. Yes, correct. So loan processing is faster for gold card. 25 days for new loan proposal, 15 days for renewal, and 7 days for ad hoc treatment. So if you need urgent loan of 50 lakh, the bank will process your application within 7 days instead of the usual timeline. So this is also correct. Now let's look at the statement number 4. This charges is incorrect. This statement like charge is incorrect. Why? Because while it is true that gold card holder enjoy a low processing charge, the 0.1% flat service charge is incorrect. Right? There is no specific 0.1% flat charge. Right? So the correct answer is 1, 2, 3 and 5 are correct and 4 is incorrect. So option number A is correct here. Right? So friends, what we learned from this discussion is that eligibility. So let me summarize the fact regarding this gold card scheme. Let me summarize. So friends, first of all, what we come to know that eligibility. So for eligibility, the requirement is that 3-year track record, right, of clean performance. Defaulter and loss maker are not allowed. Then we talked about the credit benefit. Yes, there is a priority processing for loan, faster approval and automatic renewal of limit. And then we talked about the standby credit. So at least 20% of the limit, remember, at least 20% of the assets limit is kept aside for urgent need. Then we talked about faster processing. So I talked about 25 days for new proposal, 15 days for renewable and 7 days for ad hoc limit. So friends, if you find this explanation helpful, please hit that like button. Right. So I will prepare more such kind of videos. Now let's look at the MSME scheme. This question is most frequently asked. Right. Let's try to understand the question. So friends, as per the revised definition of MSME under the Atmanirbhar Bharat Abhiyan, which of the following correctly represent the classification criteria for medium enterprise? Option A, investment in plant and machinery less than 1 crore, turnover less than 5 crore. B, less than 10 crore, investment, turnover less than 50 crore. C, investment less than 50 crore, turnover less than 250 crore. And D, investment less than 20 crore, turnover less than 100 crore. So friends, MSME is classified based on two categories, investment and turnover. So when I say investment, what it means? Investment means, in plant, machinery or equipment. Turnover means the annual revenue of the enterprise. So let me tell you the revised criteria. So basically, I will tell you the revised criteria of MSME. So what I do, I will prepare these two timeline, right? So this is investment and this is turnover, right? So first of all, micro, small, medium, right? So for micro enterprise, it is 1 crore. Just write here 1 crore, right? Just write here 10 crore. And just write here 50 crore. This is the way to remember it. And just multiply it by 5. So this is how much? 5 crore. Just multiply it by 5. This is how much? 50 crore. Just multiply it by 5. This is how much? 250. So 1, 10, 50 and then multiplied by 5. So this region is for micro. This region is for small. And this region is for medium. Now you can easily remember it. No need to memorize anything. Right? So basically for micro enterprise, investment limit is 1 crore. Turnover limit is 5 crore. For a small enterprise, investment limit is 1 to 10 crore and turnover limit is 5 to 50 crore. And for medium enterprise, for medium enterprise, it is investment limit is 10 to 50 crore and turnover limit is 52 to 50 crore. Right? So let's go through each and every option. Right? So which option is correct? Can you tell me? Yes, option B is correct. 10 for medium we are talking about, right? No. It is not correct. I think option C is correct. Right? Yes, option not B. Option C is correct. Because investment less than 50 crore and turnover less than 250 crore. This is the correct answer. So imagine that you run an IT company with investment in server, equipment, infrastructure. Suppose your investment is 45 crore and your annual turnover is suppose 200 crore. So your company will be classified as medium enterprise, right? So that is the correct answer. So friends, I hope that makes sense to you. So remember this limit. This is quite easy to remember. Just remember this word: 1 crore, 10 crore, 50 crore. 1, 10, 50, 1, 10, 50. Write it down many times. You will be able to remember it. And just multiply it by 5. The lower limit will also be clear to you. Right? So 1, 10, 50. Just we have to remember it. Now let's see the next question. The next question we have. This is a very good question. This asks you to calculate the cash accrual. Right? This question is asked in the examination, which is asked in 8 March examination, which I recently conducted. So a company financial for the year shows the following detail. Some detail has been provided to you. As you can see, net profit after tax 50 lakh, depreciation 10 lakh, amortization of intangible asset 5 lakh, interest on long term loan 8 lakh, provision for tax 7 lakh, dividend payout is 4 lakh. What will be the cash accrual? So before we jump into the solution, let's first understand what is the meaning of cash accrual. Cash accrual, it means net cash inflow generated by the company from its operation. It shows how much cash the business actually generate, excluding non-cash item. So cash accrual, the formula is the formula for cash accrual is NPAT, net profit after tax. Then you add non-cash expense, Let me write on the formula first. Then you add what? Non-cash expense. Right. So NPAT plus non-cash expense plus plus interest on long-term loan. Plus interest on long-term loan, right? So this is how we use. So now non-cash expense. So here you will see a term called non-cash expense. So what is the meaning of non-cash expense? So non-cash expense include depreciation. So depreciation is a kind of non-cash expense. Why? Because because it reduces the profit on paper but does not involve actual cash outflow. Does depreciation involve actual cash outflow? No. Yes, but it reduces the profit on the paper. Another kind of non-cash outflow, non-cash expense is called amortization. Right? What is amortization? Same as depreciation, but for intangible asset like patent or trademark, this is called amortization. Right? So remember, tax provision and dividend are not included in the cash accrual. Remember this thing, very very important. Tax payment and this dividend, right? They are not included in cash accrual. Why they are not included? Because tax provision are estimated future liability, right? Not actual cash outflow. So tax provision, they are estimated future liability, not cash outflow, and dividend payout represent a distribution of profit, not an operational expense. So that is why these two things are not included in the cash outflow. Remember it, depreciation will be included as non-cash expense. Yes, it is a kind of non-cash expense. And amortization on intangible asset, this is also kind of non-cash expense. And interest, obviously, since you have taken long-term loan, so this is a kind of net cash outflow, right? So this is cash accrual. So friends, now let's do a step-by-step calculation. So here we have NPAT is how much? NPAT is just let me erase the some area. Just wait a minute. So let me erase it. Now let's apply the formula here. So NPAT is how much? NPAT is 50 lakh plus depreciation is how much? 10 lakh plus amortization is how much? 5 lakh plus interest on LTL is how much? 8 lakh. So after adding these two, this will give you 73 lakh. So this is the net cash accrual, right? What are the options? 68 lakh, 80 lakh, 75 lakh, and I think 73 will be correct answer, right? So which option do you think is correct here? So the correct answer will be 73 lakh. Yes, so I think let us say instead of the 75, let's say this is 73. So this is the correct answer, 73 lakh. Right. So remember, what we have to remember is that cash accrual, the formula is NPAT plus depreciation plus amortization plus interest on long-term loan. Right. What to include? Non-cash expense and interest on long-term loan to include. And what to exclude? What to exclude here? So to exclude, we have provision for tax and dividend payout. Right. So this is how you should remember it. Now let's see the next question. So I hope that makes sense to you. Now let's see the next question that we have. The next question is PMEGP, that is called Prime Minister Employment Generation Program, very very important concept. So friends, let's talk about this particular concept. So which of the following statement regarding PMEGP is correct? Option number A says that it is a kind of a central sector scheme, right? So it says that it is a kind of central sector scheme administered by the MSME and implemented at the state level by the KVIC in rural area and DIC in the urban area. Option number B, the maximum project cost allowed under PMEGP is 50 lakh for the manufacturing sector and 25 lakh for the service sector. Option C, PMEGP allow funding for both new and existing project, including retail, trading and business across all region, right? And option D, generation program. It is a central sector scheme introduced by Ministry of MSME, and the objective of this scheme is to generate self-employment and to promote micro enterprise in the rural and urban area, right? So it provides subsidy based loan for new project. It focus on manufacturing and service sector, and it offers a special benefit for northeast region, left wing extremist affected district and Andaman and Nicobar Island. So option number A suggests that it is a central sector scheme. Yes, it is correct, because it is indeed a central sector scheme and it is introduced by Ministry of MSME, right? At state level, it is implementation is done by the in rural area KVIC and KVIB. Sometimes KVIB is also there, which is State Khadi and Village Industry, or DICs, right? And DICs in the urban area. In urban area, only DICs. So for example, imagine a person in rural village want to start a handloom weaving business under PMEGP. So they will apply through KVIC or KVIB for financial support. Whereas in urban area, someone starting a small cafe will apply through the DIC. Option A is correct. Option B suggests that the maximum project cost under PMEGP is 50 lakh. So this is wrong, because the under PMEGP the maximum project cost is actually 25 lakh. It is 25 lakh for manufacturing sector and 10 lakh for the service sector. So suppose you plan to start a small garment manufacturing unit, so you can get funding up to 25 lakh under PMEGP. If you want to open a service business like a saloon, the maximum funding is 10 lakh. Now option number C, PMEGP allow funding for both new and existing project. This is also incorrect. PMEGP only fund new project, it does not fund the existing project. So retail trading is not allowed nationwide. It is only permitted to a special. You can see including retail trading. No, retail trading is not allowed nationwide. It is only permitted to a special region like Northeast region, or suppose LWE, left west extremist affected region, and Andaman and Nicobar Island. So in other region, retail outlet are allowed only if they are backed by manufacturing or service facility. Let's say you want to open a stationery shop. If you are in Northeast region or LWE region, you may be eligible. However, in regular city, you won't qualify unless your business involve both trading and manufacturing service activity. So that's why option number C is incorrect. Now, next option is, under PMEGP, capital expenditure is not mandatory. This is also wrong, because capital expenditure is mandatory. You must invest in asset like equipment, machinery to avail of the loan. Trading activities are not involved, right? So you can see trading activities are permitted. No, this is wrong. Trading activity are not permitted. Remember it. Right, so they are restricted to NER LWE district. So suppose you are in NER region and you can avail of PMEGP funding if you want to open a grocery store. But if you are in metro city like Delhi and Mumbai, you won't qualify unless you are also have a manufacturing service unit alongside the trading activity. So the correct answer to this question is option number A. Right, option number A is the correct answer. Just now we have seen it. Yes, this is the correct answer. So what we have learned from this question regarding the PMEGP, that it is, first thing is that it is a central sector scheme, first point. Second point is that administered by MSME. Third point is that implemented in state level by KVIC and KVIB, and in urban area by DICs, and maximum project costing for manufacturing sector is 25 lakh and for service sector is 10 lakh, right? And retail trading is restricted to a specific region, and capital expenditure is mandatory to avail the loan. So if your concept is clear, please hit the like button, right? So I have explained each and every point regarding the PMEGP. This question is most frequently asked, right? Now let's shift our focus, right? So remember, the key way to remember, the trick to remember is that this PMEGP, Pradhan Mantri Employment Guarantee Program, is restricted to new project only, right? It is restricted to new project, and capital expenditure, capex, is mandatory, and trading is allowed in restricted region. Trading is allowed in restricted region. That is a point. So it is for new project, capex is allowed, and trading is allowed in the restricted region. The 3 point you must remember it, right? Now let's look at the consortium advance. This is a very good question. So friends, the question is, which of the following statement regarding consortium advance is correct? Option A, consortium financing is required when the loan amount is large and beyond the prudential exposure norm. Option B, a company with multiple division or multi-product operation is always treated as separate unit by different bank. Option C, under a consortium arrangement, only one bank participates in financing the borrower, right, while the other financing institution act like guarantor. Option D, in consortium, each participating bank provide finance to the borrower independently without coordinating with other bank involved. So what do you think regarding consortium arrangement is correct? So consortium banking is when 2 or more bank or financial institution come together to jointly provide a loan to a borrower. When this is done, so whenever borrower need a large loan, right, then they can go for consortium, and such a loan exceeding the lending limit of a single bank. If it exceeds the lending limit, there are limit which is placed by RBI. So if such loan, if it exceeds the lending limit of a bank, then it is done. So this reduces the exposure for each individual bank. So the borrower deals with only one lead bank. There is a concept of lead bank here, and all the bank involved share the risk. So now let's go through each and every step by step option. So option number A says that required when loan amount. This statement is correct, because this prudential exposure norm are guidelines set by RBI to limit the maximum loan amount a bank can give to a single borrower. So if a company require a loan larger than this limit, no single bank can fund it alone. So therefore multiple banks form a consortium to jointly lend the required amount, right? So for example, suppose company ABC need a loan of 500 crore, right? He need a loan of 500 crore to expand its business. So bank X has a lending limit of only 200 crore, right? So instead of rejecting the loan, bank X form a consortium with bank Y and bank Z, right? Together they jointly provide the 500 crore loan. So that's why option number A is correct. Option B, this statement is incorrect, because a company with multiple division or or product or multi-product is generally treated as one single unit if it has only one published balance sheet, right? It is treated as separate, it is treated as single unit. So bank cannot treat different division as separate entity unless they have separate financial statement. So without separate balance sheet, bank must form a consortium for a large loan. Let me give you an example to make it more clear. For example, let's say XYZ Limited, this is a company, it has three division. The first division, let's say the textile division. The second division, let's say the electronic division. The third division, let's say the pharma division. It has the three division, okay? Now, however, XYZ Limited publish one combined balance sheet, right? It just published one balance sheet. One balance sheet is published by it. Even if different bank want to finance separate division, they cannot treat them as separate entity. So therefore, they must form a consortium to jointly provide the loan. That is why this option is incorrect, right? Now let's see the option number C. Option number C says that under a consortium arrangement, only one bank participate in financing the borrower. This is also incorrect, because consortium financing, what happened? All bank involved contribute fund proportionally. No bank acts like a guarantor. Every participating bank lend money to the borrower. So no bank act like a guarantor. Remember it. There is no concept of guarantor here. So that is why this option is incorrect. So let me give you an example to make it more clear. For example, suppose three banks are there, A, B, C. They form a consortium to provide a 300 crore loan, right? So bank A might contribute 100 crore, bank B provides 120 crore, or bank C provide 80 crore, right? So all the three bank lend money rather than acting like guarantor. So this is also incorrect. And what about option number D? We will understand each and every option. So option number D says that in consortium, each participant bank provide finance to the borrower independently without coordinating. This is also incorrect, because bank don't lend independently. They work together under joint agreement, sharing the loan amount proportionally. And the borrower deals with a lead bank, right? So there is a concept of so-called lead bank. So the borrower deals with the lead bank, right? For example, suppose this company ABC, they takes a 500 crore loan, right? So three bank, X bank, Y bank and Z bank, they three bank participate. So bank X can act like a lead bank. So this bank X can act like a lead bank, and they will manage the overall process. So I hope the concept of consortium is correct. Now the correct answer to this particular question is, option number A is the correct answer. So I have explained each and every option. So if you want such kind of PDF, you can go for our CCP online course, which is available. Many candidates have already passed the examination, reading through the material. You can also join it. The link is provided in the description section. Now let's see a very important question regarding calculation of net cash flow from operating activity using the indirect method. This is a very good question. So friends, let me show you the question. So XYZ Corporation, right, provide the following financial detail. Net income $1 lakh, depreciation expense $10,000, increase in account receivable $5,000, decrease in account payable $3,000. You need to calculate the net cash flow from operating activity using the indirect method. So friends, before we dive into the calculation, let me quickly explain what is the meaning of this indirect method. The indirect method is used to calculate cash flow from operating activity by starting with net income. So you start with the net income, right, and adjust for non-cash expense. I think you are familiar with this term non-cash expense. We have already talked about it in the previous question. And then also you adjust for change in working capital, change in WC. So let's calculate the non-cash expense for the net cash flow from operating activity using the detail provided. So you start with the net income, which is how much? 1 lakh. Now you add the non-cash expense. So depreciation is a kind of non-cash expense, so you add it. So it will become plus 10,000. And then depreciation is a non-cash expense, which means it reduces the net income for accounting purpose, but does not involve an actual cash outflow. Does it involve actual cash outflow? No, but it reduces the net income for accounting purpose. So that is why we add it back to the cash flow, right? Try to understand what I am telling you. This is a kind of non-cash expense, because this depreciation, it reduces net income. The net income get reduced because of depreciation, right, for accounting purpose, but does not involve. So there is a no cash outflow. Since there is a no cash outflow, so that is why we add it, right? Accounting purpose it reduce it, but is not a kind of cash outflow. That is why we add it, and we adjust for change in the working capital. Now see, there are two things. Account receivable is increasing, account payable is decreasing. So whenever account receivable increase, it means the company has made sale but has not yet collected the cash. That is the meaning of account receivable. So therefore it reduces. Try to understand what will be the impact of the increase in account receivable. Try to understand what will be the impact of increase in account receivable. What is the meaning of account receivable? That means company has made the sale but has not collected the payment yet, right? It has made the sale but had not collected the payment yet, right? So that is the account receivable. That is the meaning of account receivable. So it reduces the cash flow. This account receivable, it reduces the cash flow. Why? Because the company has made the sale but has not collected the cash, right? So till now what we have this 1 lakh. From that we added this 10,000. Why we have added the 10,000? Because we have added the 10,000 since this depreciation expense is a kind of non-cash expense, right? So it reduces our net income for accounting purpose but does not involve an actual cash outflow. That is why we add it back to the cash flow. And so if we talk about the increase in account receivable, it means the company had made the sale but has not collected the cash. So ultimately what it does, it reduces the cash flow. So that is why we have subtracted this 5,000. It reduces the cash flow. Now what about the decrease in account payable? So when account payable decrease, it means the company has paid off some of its liability. So this results in cash outflow, reducing the cash flow, right? So ultimately this will also be subtracted, right? So that is the point. So ultimately after doing the calculation, you will get how much? 1,02,000, right? So that is why option number C is the correct answer. So that is why option number C is the correct answer. So what we learned from this discussion is that cash flow from operating activity involves starting with net income, adding back non-cash expense like depreciation and amortization, right? And adjusting for change in the working capital like increase in receivable, it will reduce your screen. Let me skip this question and let's see this particular question. This is a very good question regarding this letter of credit. Yes, let's try this question, right? So the question is saying that let's try to solve this particular question. This is regarding LC limit. This question is most frequently asked and very, very important from examination point of view. So friends, let me show you the question. A company has the following detail: annual raw material consumption. So you can see annual raw material consumption is how much? 6 crore, right? Economic order quantity is 1 crore, right? Lead time for delivery is 10 days, transit time is 20 days, Ujans period is 6 months. So question is, what will be the LC limit for the company? So before solving the question, let me explain the limit. What is the meaning of LC limit? This is the maximum amount of credit the bank allow for company to open LC for import. So suppose some company want to open LC for import. What is the maximum amount of credit that bank can allow? And the second thing we have is the economic order quantity. So this is the optimal quantity of company order to minimize total inventory cost. In this case, EOQ is 1 crore. What is the meaning of Ujans period? What is the meaning of Ujans period? So it simply means the credit period the supplier grant before payment is due. So here it is 6 months. So this is the credit period that supplier grant before the payment is due. And the lead time, lead time is the time it takes the supplier to process and dispatch the order, which is 10 days. And transit time is, that this is the time for goods to arrive at the company location. Now, first we need to find out. So let's go step by step. We have to calculate the LC limit. So the options have been given. So let me show you the options. So these are the four options: 1 crore, 3 crore, 4 crore, 7 crore. So let's solve this step by step. First, we need to find out how long an LC remain active from the time of order until payment. So this is the time of order, right? And this is the time of payment. So question is, how long LC remain active? So calculating the duration LC remain outstanding. So how to find it? So it is, you have to just add the time. You take LT, you add transit, and finally you add the Ujans period. So add all of them. So how much it is? 10 plus 20 plus 6 months or plus 180, which is how much? 210 days. So this 210 days is approximately 7 months. So basically this means LC remain outstanding for 210 days. This is the step number 1. You have to find how much time LC remain outstanding. Second thing what you have to do is to determine the LC frequency. Second thing, you have to find the LC frequency. How to go about finding the LC frequency? So friends, LC frequency is very easy to understand. So let's determine how frequently the company open LC. So you can see annual raw material consumption is how much? Is 6 crore. Economic order quantity is how much? 1 crore. So number of LC per year, try to understand. Number of LC per year is how much? It is nothing but 6 upon 1, which means 6 LC annually. 6 LC is open annually. So since the company uses 6 LC in a year, the frequency, what will be the frequency of opening LC? So frequency will be how much? It will be 12 months divided by 6. This will be how much? 2 months per LC. 2 month per LC is the frequency. This means company open a new LC after every 2 month. Now, so this is step number 3 that we have calculated. Right. So friends, till now we have seen 3 steps. Right. In step number 1, we've calculated the number of period for which LC remain outstanding. In step number 2, we calculate the duration. Then we calculate the LC frequency, which is how much, 2 month per LC. Now then we determine the number of LC outstanding at any time. How many LC will remain outstanding at any particular time? So total LC outstanding period is how much? Total LC outstanding period is 210 days, right? And the company open a new LC every 2 months. So the number of LC outstanding at any time will be 7 months divided by 2 months per LC, which is approximately 3.5, or we can say 4 LC by rounding it off. So therefore company will have 4 LC outstanding at any time. And final step we have to calculate the LC limit. Finally we will calculate the LC limit. How we calculate the LC limit? So now we know that there will be 4 LC outstanding at a particular time. So LC limit, the formula for calculating the LC limit is very easy, that you find number of LC outstanding multiplied by LC amount per order, multiplied by LC amount per order, right? So how many number of LC outstanding? 4 LC outstanding. What is the LC amount per order? 1 crore. So it will be how much? 4 crore. So the company need LC limit of 4 crore. So answer will be 4 crore, right? So how to go about finding the answer to this question? Let me explain once more. First thing to do is to find LC outstanding period. In this case, this is 7 months. Second step, you have to find number of LC per year. Number of LC per year. In this case, how to find it? You take the annual consumption, you divide it by EOQ. This will give you number of LC per year. In this case, it is 6 LC. Then you have to find the frequency of LC, right? Then you have to find frequency. You divide 12 by number of LC. So friends, how to find frequency? Divide 12 by number of LC opened, right? Number of LC per year, this will give you frequency. After finding frequency, you have to find number of outstanding LC. How to find number of outstanding LC? Just divide this LC outstanding period by the frequency, right? So in this case, it is how much? 7 by 2, which is 3.5. And the last step is to find the LC limit. How to find LC limit? Number of LC outstanding multiplied by LC limit, right? EOQ multiplied by EOQ, right? So this will give you 4 times 1, which is 4 crore. So these 5-step process you have to find. So LC limit must cover all the outstanding LC at any given time to ensure the company has sufficient credit for its import, right? I hope you have now a clear understanding of how to calculate LC limit using EOQ and the factors involved. So friends, there are some more questions. If you want to make the part 2, make a part 2 lecture, please write yes in the comment section. And if you want any kind of study material, feel free to WhatsApp me on this particular number. Thank you for your time. Thank you for watching this particular